Everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in, take a look, see what's going on today. If you want to follow me at @Finance, and if you want to join our community, findinghypervalue.com, I dive deeper into all these topics and subjects, sharing my opinions about everything, looking for potential investment opportunities, sharing those opportunities with everyone in the community. We just recently went over some Elliott wave analysis on the big, long picture view, and it is very, very good in terms of its projections for commodities over the next decade. So we still have a special going on for coupon codes. Special is that coupon code. You get 50% off the first month only on a monthly membership and a larger discount on the yearly membership if you'd like to sign up. You can always switch from a monthly to a yearly as well if you'd like. Starting off with Gold Ventures, he says gold is up $500 an ounce in only 8 days since Trump ended the dollar being the reserve currency. That's pretty bold statement. Don't count on normal corrections, normal cycles, normal retraces. We are in uncharted territory. Silver to follow once the U.S. 10-year blows up. You know, I don't know what to believe is where my head's at. I don't know if this is a new paradigm, what he is stating. I don't know if this is a normal move higher because of the tariffs coming into play and people fearing a recession, because gold goes up when recession goes up, the probability of recession. So how does one distinguish between the normal move in gold because of recessionary fears or that we have a major problem in the market? Now, one of those things that I look for that might indicate that Gold Ventures is right is that we have a weaker dollar, and at the same time, our 10-year yield is going up on the long end of the curve. That is a little bit different from what we usually see in a recessionary fear response. Recessionary fear responses, generally people run to the dollar and to bonds, and you'll see a decline in yields on all of the curve, and you see strength in the dollar. We have that opposite response. We've got weaker dollar and stronger yields, which is a big head scratcher. It's like, okay, is this completely different now? And that very well could be the case. So I hear a lot of people talking about on Twitter and other posts saying that, oh, we're going to get a pullback in gold. We're going to get a pullback in whatever. I don't know. I'm not of that camp. I don't know if we're going to get a pullback. Maybe we do. Maybe we get a consolidation or something. I'm not exactly sure. But what I can do is I can control if I buy or sell things. And I'm not going to sell anything that is precious metals related here. So I don't trade the markets. I use precious metals to protect my wealth, my purchasing power, and my savings. And that's the way that I view it. And if there is a problem in the market, then I will be protected. That's the way, I view it. I'm not here to try to make purchasing power gains on my precious metals per se. I mean, I do ratios, and I do load into different asset categories based off the valuation. And I'm sure those will go up even if we do have a problem with our currency, if there is one. So is it different? I don't know, guys. This is when we start going in uncharted territory, like he says. My default is, well, you don't see this too often in history. We do talk about Weimar Germany below. Someone put a post up, and we will talk about that. But I can tell you this: I'm not selling anything precious metals related. I mean, you got to rip it out of my my hands somehow if you're going to rip it out of my hands. I mean, there's no way I'm getting rid of this stuff. And in fact, I would be looking for opportunities to acquire more of the metals that I think are cheap and that are down. So he very well could be right. And that is in the back of my head, sitting in there, looking for more information on how maybe this move is different than others. Art Berman says WTI comparative inventory deficit is the greatest in 2.5 years, yet price is at its lowest level since late COVID. What he's talking about is this deficit that we continue to run in inventory for oil. And this is the WTI comparative inventory deficit is the greatest in 2.5 years, yet price is at its lowest level since late COVID. It is a head scratcher. It's over 2 standard deviations away from its fair value given inventory levels. How? How and why? And I'll go over some more stuff below on some quotes. Maybe someone's in there trying to do stuff. I don't know. But I view it as an opportunity. And when things start to diverge from the average, and they diverge over what's called 2 standard deviations, which has statistical significance, I start loading up because, again, we don't know the exact reason why. Maybe the markets are trying to price in a bad recession. Maybe it's already priced in and it's about to turn. That's the big question mark. No one knows that answer. But could it go down further? It could. I'm not stating that it can't. But there's a disconnect in valuation of gold to silver, gold to oil, and these disconnects are huge. So one could state that there is recessionary fears in the market, or something is different than normal in history because the divergence between gold and silver, gold and platinum, gold and oil is at extreme levels. Does that mean that gold is front running a gigantic move in commodities? Yes, it could be. That very well could be the case. Is gold front running some gigantic printing press event that's coming? Maybe. Maybe we're going to do QE to the max. Maybe they're going to print and do stimulus or do something that gold knows that's coming. I don't know for sure, but we're going to find out. We're going to find out with time. Johnny Oilwell says gold and oil typically trade together, linked loosely through inflation. This market has broken another correlation. Gold is up 2x in 12 months, and oil is down. Gold typically moves first, faster, and further. Does oil correct up? Does gold correct down? Time will tell. And you can see these relationships where oil and gold move together. Gold has diverted away from everything. It is ripping to the upside. And I wish I knew the exact reason of why. People are going to put articles, they're going to say, they make up the reason why. They'll say, well, central banks are buying it, or the tariffs initiated this potential move, which is could be true. Maybe the dollar is going to have major problems, maybe the bond market, maybe perhaps both. And gold is more sensitive to that than oil is. But we see this large disconnect. Every time in history, what we've seen is gold moves first, the ratios get cheap, gold to silver, gold to platinum, gold to oil, etc., etc. And then they generally follow behind it, where they move up to meet gold at what I would consider to be a more reasonable ratio through history or through time. So I think gold's doing what it's doing. It's leading. I think that there is fear in the market. Gold generally disconnects from the others during that time frame, and then they reconnect later. The exact time frame, it's difficult to say, but we can look at previous times in history. Usually gold runs for a year and a half, 2 years, and gold's been running for a year and a half or 2 years. So we very well could turn at any time for a lot of these other commodities. And that's what I'm watching for. But there is a disconnect right now between them. So gold was up 4x, oil was up 2x. Gold down 33, oil down 50, gold up 2, oil up 2. I think we're going to see gold and oil go up massively. I mean, massively. I think there's problems in the market. And I think they're going to be rooted in oil, is my guess. The longer oil is suppressed, the brighter the future. Yeah. So here's Francois. Gold will collapse. This is Weimar Germany. The value of one gold mark in paper marks. So back when we were coming up, gold is overbought. Gold is going nowhere. Gold is screwed, and gold is going to collapse as this went up vertically over the next 2-3 years. And that's Weimar, where it went vertical. We've got a similar pattern here. If you look, this was a cup and handle that's broken out. It's just angled upward to some degree, and we just broke out of our cup and handle. And we could be somewhere in the 1922 era coming on up where we go vertical. Maybe, maybe not. Maybe this time's different. Tough to say. But I'm already positioned for all this. So if it occurs, okay. A lot of other people are not positioned for this. They are not anywhere near positioned for this outcome. Coming down, oil prices have deviated significantly from their long-term inverse correlation with global inventory levels. This is worth watching. And again, this started pretty recently, this divergence. We have a large divergence where inventory levels are very low and the price is going down as we eat through more and more inventory. There's the divergence. The fair value of this divergence is $95 is the fair value for where inventory levels are at today. But we've got this divergence that exists. It is over 2 standard deviations away from fair value compared to history. Warren Buffett says, if you worry about corrections, you shouldn't own stocks. The point is to buy something that you like at a price that you like and then hold it for 20 years. That is his opinion there. So find good companies, buy good companies, and ride through volatility. The year is 2025. The bond market is trading like the stock market. The stock market is trading like meme coins during a rug pull. And yet meme coins are somehow now a safe haven asset. That is kind of weird, and I thought it was pretty funny when I first read this. Here's Tavi. He says, another day, another rise in recession probabilities. Yet 2-year yields continue to hover around 4%. Here is a reminder that yields typically collapse as recessions unfold. What's different this time isn't just the natural risk of a downturn, but a political environment that needs lower rates, even if it means replacing the current Fed chair, directing banks to absorb treasuries, initiating treasury buybacks, or resorting to whatever measure policymakers can come up with. In his view, the 2-year yields are set to decline meaningfully from here. So he thinks that we could see a meaningfully drop in the 2-year yield. This is a very difficult environment. Usually the 2-year, 10-year, and 30-year kind of move together. The 2-year moves the most, and then the 10-year less, and the 30-year even less. So the long end of the curve is generally anchored more so than the short end of the curve. And that's what causes the 10 and the 2 and these yield curves to invert and uninvert. It's the 2-year moving at a faster rate than the 10-year. It's very rare to see the 2-year go down and the 10-year go way up, which is a head scratcher. It's like, what's going on here? What is going on? So people are selling the long end of the curve and buying the short end of the curve is what that is signaling, which is kind of weird compared to history. Markets and Mayhem says tariff revenues coming in well below estimates. Doge savings coming in well below estimates. Sensing a theme here. So CBP says latest tariffs have generated 500 million, well below Trump's estimate. Another one from Market Mayhem says, I don't know how much more of this winning I can take. China sends back new Boeing jet made more expensive by tariffs. With estimated 55 million price set to balloon by 125%, 737 MAX returns to Seattle production hub, still wearing the colors of an airlines there. And I don't want to try to pronounce that. This could end up pretty nasty, guys. And these tariffs, I don't know what the end result is, but we very well could end up in a recession. I mean, there's a lot of people delaying purchases because the price of tariffs are so expensive. So there's a lot of things being rejected just like this. And I can't imagine that that's going to be good for the economy. I can't. And with the tariff stuff still in place, this could get pretty jiggy with it here soon. I think gold's pricing that in. Now, does this mean that our currency and our interest rates are going to go, one's going to go ridiculously lower and one's going to go ridiculously higher? I'm not sure. Is this time different? Difficult to say. I'm already positioned like it's going to be a bad outcome. And I'm not saying positioned in terms of like equities. I'm just saying precious metals. I've positioned for this for a while because of the debt problem that America is in. But in the short term, this does look pretty discouraging. And the chance for a recession is definitely increasing with news like this. Trump, there's virtually no inflation. Welcome to the United States of Zimbabwe. I think bad things are going to be coming for prices. Maybe, the tariff related is what I'm talking about. And I don't know what it looks like. I'm not sure. I don't know when it will exactly hit. I'm sure there's some inventory we're basically destocking now, and then it's going to look pretty ugly at some point. Uncertainty. We have an extreme in uncertainty. Uncertainty about trade policy soars. Bloomberg economic index is near an all-time high. Trump wins the election, and uncertainty is skyrocketing. That is what's causing problems in the market. It's uncertainty. And look how high uncertainty is. They're contemplating the same thing that I'm contemplating. What's the impact of these tariffs? How bad will it be? Will they get reversed? What's the final rate that this thing's going to be? No one knows. And there's the uncertainty. It is spiking. Darius Dale says, I hate saying I told you so, but our friend Bianco Research is calling out what I continue to flag as the single biggest risk to asset markets I've seen in my career. In his career? Okay, what's going on here? So Jim says the breaking of this relationship is a measure of stress in markets. It continues to widen. Higher rates are not supporting the dollar right now. This means they might have to go a lot higher to stop the dollar from falling. And this is okay. So looking back at history, we've got this relationship of rates and the dollar. They move together. Do you see that relationship? Do you see on the right-hand side that relationship has been broken? The blue line and the yellow line have disconnected and are moving in opposite directions. Very much like oil and gold. Very much like oil and gold. And we're seeing these relationships kind of break apart. We're seeing silver break apart from gold, oil from gold, platinum from gold. We're also seeing this DXY and 10-year yield. Is this a problem and will it persist? I'm not 100% sure here because we're seeing a lot of relationships in history break down. Is that because we're in an increasing interest rate environment? Is it because things are breaking in the system? What's breaking? How bad is it breaking? Is this because of recessionary fears? I don't think so. Recessionary fears generally have lower yields and lower dollar. but we've got this disconnect. What is it? Don't know. This is part 2 of Jim. He says, screaming red headline tonight, Bloomberg Dollar Spot Index falls to the lowest since January of 2024. The Bloomberg Dollar Index is 99% correlated to the DXY. It also has an ETF that tracks it. Over the last 70 days, BBDXY has lost 8% of its value. This is the second biggest loss over 70 days in 15 years, and it is still falling. However, the January 2023 low was coming off a massive dollar peak when everyone rushed into the safety of the reserve currency in the wake of the Russia-Ukraine war in April of 2022. This move is slumping to oversold levels. So are we going to get a bounce because we're at oversold levels? I don't know. This is pretty interesting of what's going on, and we'll continue to monitor it here on the YouTube channel as I see more information of it. Christine says, forward expectations for U.S. shale are changing. The EIA has a very different production outlook today compared to in 2023. The long plateau shifts into decline for oil production. So commodity prices, their expectations of kind of what they're drawing out here. So they think that oil could go up a little bit over 2025, maybe even up to $80 or $90 a barrel by the end of the year. They've got look at what they've got here. U.S. oil production potentially peaking in 2025 and rolling over. That is interesting as we come back down here from 2025 onward. So that's a huge difference, and maybe this is having an impact on bond yields. I'm not sure, but that's another interesting fact that they're starting to basically come up with a decline in shale here in 2025. That's a pretty stark admission there, or a potential rollover here in 2026 or 7. Like, it's basically rolling over, put it that way. I thought this was interesting. It says you have 30 minutes to hide a USB drive in your house. Your house will then be raided by the police, detectives, and some FBI agents, all searching for the USB. Where do you hide it so that it won't be found? Well, I came up with 2 solutions. I kind of read this and thought about it a little bit. One of the solutions is that I go up above in my garage. There's a spot over one of the garages that you can go into, and there is some there's some what's it called? God, I can't even think of it. Insulation up there. There's insulation up above in the garage that insulates the house. I would probably try to hide it up there inside of the insulation, perhaps. Another idea could be there's batteries that go into my kids' toys. I would remove the batteries out of one of the kids' toys and put that in the spot where the battery would be located. And some of them have little screws that hold the cover on. I could put it in the kids' toys where the batteries are located, perhaps. Or you could put it in a flashlight and put it in there. There's other things that you could potentially do if you get really interesting. You could, put it in like the shades or something like that, somewhere like between. You stick it between something like where the shades are at. But I'm sure that would get checked. So I probably wouldn't put it there. But there's a couple ideas. Eric Ewan says, exactly what I'm telling people, gold liquidity is key. Few people understand the logic of gold uptrend, are afraid of a correction. The current rise is due to an ongoing great change of the world. A decade-long acceleration period. The single hegemony replaced with the multipolar. Gold is the only benchmark for currency system reset. So maybe this time is different, and maybe that's what we are experiencing is a currency system reset. Could be. I mean, I could buy it, but it doesn't change any of my actions that I've already taken. If we have a currency system reset, we had very large commodity bull markets after these currency system resets. So it's basically something that was part of an expectation. I mean, loosely, 1931 gold was revalued, and we had a commodity bull market shortly after as everything was repriced against gold. Those ratios withheld against gold being revalued higher. 1971, we went off the gold standard and gold revalued and everything else revalued with it. Gold's going through another revaluation here. And I think all the commodities are going to go with it, just like in history. It's the same thing. It says that's right. They're failing to understand that fiat system is sinking, and we might just have reached the exponential phase of the cycle. Stop worrying about price and worry more about holding on to a suitable allocation, is what Jamie Koresko is saying. And he's obviously showing these moves in all these different currencies. This is Weimar, but he's got a whole bunch of different currencies that are all going vertical, all of them. So here's another thing to think about, guys. The last gold bull market was mainly contained to the United States. I think now that it's everything. Gold's going to revalue against everything. I think silver, when it gets going, it's going to do insane things. And same with platinum and palladium, everything. Everything's going to rip. So here we are. We're going through it. We're at the beginning stage of this, what will probably be a vertical move in commodities. And here we are. That's where we're at. So stop coming at me, bozo. Go fix your crap and stop blaming me for everything. This is preemptive cuts in interest rates are being called for by many with energy costs way down, food prices, including Biden's egg disaster, substantially lower and most other things trending down. There is virtually no inflation. With these costs trending so nicely downward, just what I had predicted they would do. Wait. So he said, with energy costs way down, food prices, and this egg disaster substantially lower, he himself, just what I predicted they would do. There can almost be no inflation, but there can be a slowing of the economy unless Mr. Too Late, a major loser, lowers interest rates. Now, Europe has already lowered 7 times. Powell has always been too late. Why is he posting this? I don't understand that. But the thing that I got there was he was expecting lower energy prices. And we're seeing these large disconnects at 3 standard deviations away from fair value. Is there any correlation between these two? Are they in there trying to push oil prices lower to try to get Powell to lower interest rates? Is there something going on? I don't know. It seems fishy to me. Cycle Bottom says what to do near cycle bottoms. A, deploy into the high torque plays as this is the point of zero risk. B, large caps are not high torque. C, the return on high torque is often 5x that of low torque. So what he's saying is, as you reach bottoms of these cycles, the lowest risk entry point should be taken advantage of with high torque plays. The high torque plays are not large caps for the most part, and high torque plays often outperform the low torque plays by 5 times. I agree. I am in the high torque plays, but I will say high torque comes high volatility. Get ready for high volatility in the high torque plays if you're playing it that way. But I agree. I think we're close to cycle bottom. Yep. This is Michael Saylor. Global money supply is exploding. Look at this, guys. All-time high, close to all-time high for US, Japan exploding, China straight vertical, Euro straight vertical. It's ridiculous. That's the problem. That's the decline of the currencies, and that's what gold is pricing in. Vertical money supply growth. This is Mark, and he posts Bob Farrell's 10 market rules to remember. So let's go over the 10 market rules together. He says, markets tend to return to the mean over time. Number 2, excesses in one direction will lead to an opposite excess in the other direction. 3, there are no new eras. Excesses are never permanent. 4, exponentially rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. Number 5, the public buys the most at a top and the least at a bottom. 6, fear and greed are stronger than long-term resolve. 7, bull markets are strongest when they are broad and weakest when they are narrow to a handful of blue chip names, and that's exactly what we went through. Number 8, bear markets have 3 stages: a sharp down, a reflexive rebound, and a drawn out fundamental downtrend. Number 9, when the experts and forecasts agree, something else is going to happen. And number 10, bull markets are more fun than bear markets. There we go. This was kind of interesting. Has the VIX entered a secular uptrend? Based on the 36-month lead from the reversed yield curve aggregate, history suggests we could see elevated volatility persist through 2026. Buckle up, the calm may be over. So the VIX has started a secular rise, perhaps, where volatility continues to get worse. That generally occurs at market tops, not market bottoms, or market tops. It doesn't occur in the middle, usually. So that's what we could maybe see. We'll see if that continues to work its way on higher and goes into an uptrend for the VIX. Warren Pye says the post-Liberation Day cross-market price action has been unsettling and unprecedented. Bonds and the dollar are falling together. At the height of the panic, 410 and 11, the 10-year had risen by 40 bips and the dollar fell by 3%. This combination has only happened 12 days since 2000. And that's where you don't have a lot of data. That's where the big question mark comes and the uncertainty in this market. What's going to happen? Because you don't normally see this in the markets. Generally, you'll see stronger yields and stronger dollar, or weaker yields and weaker dollar. And if you get into fear, you see stronger dollar and weaker yields. We're seeing the exact opposite. And it's like, what do we look for in history? There isn't much. There isn't much. But 12 days since 2000, that's the only time, only 12 days has that occurred. And we've got a whole bunch of them occurring right now. Here, actually, he's got the days here. 9/19/2008, gold 10-day return and S&P 500 10-day return. So there's some in 2008, 2009, 2011, and now in 2025. That's rare to see the 10-year up 40 bips and the dollar down 3%, and that's it. 08, 09, 2011, and 2025. Rock bottom entries. The next decade in commodities offers an early retirement ticket for anyone with even modest starting capital. We likely won't see a better investment landscape in our lifetimes. Cash in, hang up the mitts, and live out your days in peace when it's done. This is the 10-year inverse head and shoulder pattern on the right-hand side for the S&P TSX Venture Composite Index that's ready to break higher. It looks good. And then Grady says, if gold is a 5x from here at least, which I think, imagine where platinum would be if this ratio goes back to all-time highs, which I think it will. This blue mega pattern looks ready now, finally. Platinum has a very, very long way to go as posted, but what the exact final target price will be is not important right now, really. What is important is to get ready and get the best guidance. Even before I called the commodity bear market low back in 2020 in real time, I said platinum will outperform gold and silver in the coming bull, pioneering platinum case here on FinTwit. I like that. I'm loaded in platinum. Let's do this. As said for the last 5 years now, do not make use of what will be the greatest commodities bull market ever seen. It will absolutely be your greatest market opportunity in life. And what he's showing here is the platinum versus gold ratio doing a false breakdown right now, where we could see 700% potential upside against gold, which means if gold goes higher, platinum's could outperform gold by 8x. 700% or 8x. That is crazy. We'll see what happens there. And this is just, I'm not going to go over this. I think we're going to end it there. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specialist coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.